Lululemon is an interesting merchandiser that's growing to beat huge rivals on some critical metrics, like Nike and the critical metric profit margins. Lululemon has demonstrated profit margins comparable to or even better than Nike in some cases. So, understandably, investors are interested in Lululemon stock, but they are curious on what's a fair price to pay. Well, in this video, I'll share with you what I think is a fair price for Lululemon stock or the intrinsic value calculation as is calculated by my discounted cash flow model. So let's jump in and take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so what you see in front of you is my discounted cash flow valuation model for Lululemon stock. 3 sections overall: the free cash flow section highlighted in the green, the cost of capital section highlighted in the blue, and the per share calculations highlighted in the red. So I'll go with you one step at a time, describing what each of these calculations mean and each of the numbers, and letting you know where I got all the numbers from and describing these figures. So let's start with the free cash flow numbers. In 2024, the company generated $1.64 billion in free cash flow. According to Wall Street analysts, they expect this number to grow all the way to $2 billion in 2029. That's a slower rate of increase in free cash flow than Lululemon had in the previous 5 years, and that coincides with the company's slowing growth rate worldwide. Between 2029 and 2034, I forecast the company's free cash flow will grow from $2 billion up to $2.847 billion, or in other words, a compounded annual growth rate of around 7% between those 5 years. From 2035 onward, I forecast the company's free cash flow will grow at 5%. That's the rate of increase I expect with developed economies worldwide, nominally, not inflation adjusted. Between 2035 and infinity, the company's free cash flows are forecasted here in the terminal value or calculated here in the terminal value of $44.48 billion. This calculation takes the free cash flow expected 1 year ahead, divided by the weighted average cost of capital minus the growth rate. And that brings you the value of $44.48 billion in 2034. So those are all the expected free cash flows. If I bring them all back to today or discount them all back to today, I get a value of operations of $25.77 billion. And the discounted cash flow valuation model, what it does is it says the value of a business today is worth the discounted cash flows expected between today and infinity. So you're paying a price for the business today based on what its cash flows are expected to be between now and infinity. You're not paying a price for the business based on what you think you can sell it to somebody else for. You're paying a price for the business based on what you think its cash flow will be. So you're assuming in this calculation that you're going to keep this business forever. Now, if you get an opportunity to sell at some point, of course, you'll take that opportunity. But this calculation just assumes that you're going to hold on to it. All right, so I've talked about discounting these cash flows and what does that really mean and what's the discount rate I'm using. Discounting the cash flows just means that money in the future is worth less to us than money today. And for a number of reasons, right? The opportunity cost, the risk, those incorporate into the discount for those future cash flows. The discount rate I'm using specifically for Lululemon is 11.72%. The way I arrived at that is I gave them a cost of debt of 7.5%, which I arrived at by adding a risk premium to the government bond yield of 4.75%. The cost of equity I'm giving them is 12.2%, and I use the capital asset pricing model for that calculation. And that calculation takes the risk-free rate, and it adds to that the company's beta times the market risk premium. The company's beta is 1.24, and the market risk premium I'm using is 6%. Historically, Wall Street analysts have used a market risk premium between 4 and 6%. A market risk premium on the higher end calculates a lower valuation. A market risk premium on the lower end calculates a higher valuation. Since the company has a market cap of 50 billion and total debt of 1.2 billion, I give them a target capital structure of 10% debt and 90% equity. Now we can go to the middle section in red here to look at the per share calculations. So the value of operations at 25.77 billion, we need to add the company's cash balance of 3.6 billion, subtract the debt of 1.2 billion to get to the value of equity of 28 billion. From this value of equity of 28 billion, we need to divide by the number of shares outstanding the company has, because you want to buy one share of stock, right? We want to see the price for one share of stock. So we're going to divide the value of equity by the number of shares outstanding to get the price per share. And that price per share is $229. That's significantly below the current market price of $414. Now remember, I just walked you through all of these numbers, and in those numbers, I used several estimates and assumptions to come to that conclusion. So I apply a margin of safety when I'm making these calculations of between 5 and 10% to account for the fact that some of these estimates and assumptions can be wrong. And so I conduct these calculations just for my informational purposes, just so I know what my calculation is on an intrinsic value for this business. And when I have a business like Lululemon that I would like to own, I keep this number in mind so that if the current market price approaches that number, I highlight this stock and keep an eye on it for a potential purchase. But I don't just look at this one calculation, I look at several other factors to come to a conclusion on buying or selling the stock. It's just one of the numbers I use. And especially one of the numbers I use and refer to when I'm dealing with a company that is an attractive business to me, that has all the other characteristics that I want in a business, but the only thing stopping me from buying is valuation. And so I keep these numbers in mind so that if I find the business that I really like, it's just a matter of price. And so I just wait for that market price to approach my intrinsic value per share so that I can really turbocharge my research in the business and decide if I want to buy it or not. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.